Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us for this segment, we have Jeff Kilburg, Chief Investment Officer and Portfolio Manager over at Sanctuary Wealth, to discuss the market's reaction to Jackson Hole. And Jeff, it seems as if the bond market isn't convinced the Fed is as hawkish as it may be projecting.
You're right, Joe. It's a bifurcated response. You're seeing equities, certainly, selling pressure. And one of the words that Fed Chairman Powell utilized in his very brief remarks today out of Jackson Hole was the word pain. He said it twice. And what are we seeing in equities? We're seeing pain. We're seeing the Nasdaq 100 down over 3%. The other major indices in the Dow Jones, as well as the S&P 500, down over 2%. What's interesting is that is an exact, not opposite reaction, but a very different response from the bond market. And I like going back to where I cut my teeth in the fixed income U.S. Treasury pits of Chicago. Well, the 10-year note itself hasn't moved. And the probability on the CME Group's FedWatch tool really hasn't moved. So I'm still in the camp that the Fed is doing a lot of talking. I kid around and I invoke an old Looney Tunes conversation or cartoon. Fed Chairman Powell is a bit of a chicken hawk. He's talking very hawkish, but I think they have the ability to do 50 basis points. But the one thing that the market is so spastic to react to that we have to take a breath and realize, Joe, this is only halftime. We're only halfway between the last meeting and the next meeting where they actually move interest rates. So you're absolutely right to point out the fact that the bond market is providing different. And I have to go back to this whole year of 2022. The bond market has continued to provide leadership. And to see high beta stocks, specifically the Nasdaq 100, it's almost a little bit fearful of a reaction to see them sell off without the 10-year note really moving much higher, above 3%.
Perhaps that was a smart strategy on Powell's part by keeping it short and brief. There's no reason to inject more uncertainty into the market. And to your point earlier, the Fed can't move that fast either to the hawkish side or dovish side. You also don't want to pull back on the current strategy either. I mean, we really remember that clearly, but if history is a guide, we saw what happened with Volcker's Fed in the 80s by reversing course so quickly and the outcome of that. So I think it was smart to be brief, and I think it's smart to stay the course and not reverse it so quickly, because that could send a bigger shock into the system.
No, it's an absolute great point you bring up. And I think the Fed, we have to realize and go back outside of the year 2022. We've become so acclimated to the Fed is either cutting rates or raising rates. And there's actually a moment in time where the Fed just sits and monitors and takes in the data. Now, here we are after two historic moves higher in rates. We have to consider, what are they going to do next? I think we have a lot more data points between now and then. I think the Fed has to err or fall on the side of the fence that's more hawkish just to combat inflation. You talk about inflation, if it's 7%, 8%, 6%, or 5%, that's still way above their target. So I think they have to articulate that and continue to articulate that. And as we get closer, if we do continue to see this inflation specifically abate with some of the CPI and the PPI or PCE data coming out, that allows them to go 50 basis points. 50 basis points is still moving rates higher, achieving their goal and combating inflation. So a little bit of mixed messaging today. I think it's okay. I think last time I was on, Jill, we talked about how we had that move off of those June lows. We saw the S&P 500 rocket. It was about 19 trading days when it went from its 50-day moving average up and kissed the 200-day moving average at 43.25. That was too much too fast. And now it's very healthy to see this back and fill. It doesn't feel healthy on a day like this when you see the major indices move 2-3%. But this is actually an encouraging sign in the wake of a really positive earnings season.
Right. And to your point about feeling the pain, just because the Fed takes rates higher, it doesn't mean that the situation is going to fix itself in the next day or two. It's going to take a few months for this to cycle through the system and allow the strategy to play out. So I think there needs to be some patience for investors. I mean, it is painful as, everyday people paying for higher gas and food prices, but it will require some time for the strategy to work.
That's right. But you have to realize the way all investors, retail, institutional, hedge funds, we become so acclimated to these markets and so correlated to every sneeze and every cough coming out of the Federal Reserve. They're on the cover of every newspaper this weekend. They're going to be on Barron's. They're going to be on New York Times. No matter where we look, it's about the Fed. And it goes back to the one thing we haven't brought up. One thing yet is their balance sheet. Their balance sheet is still very swollen at $9 trillion. So I take a bit of solace in the fact that, yes, we're going to see some volatility. Yes, I think it's healthy. It doesn't feel great, but longer term, I don't see the recession. I don't see this being a bear market rally. Some of the technical folks say, oh, we didn't close above the 200-day moving average, the S&P 500. It's absolutely a bear market rally. I'll take the other side of that conversation. If you look at the market breadth, earlier this month in August, Jill, we saw over 90%, 93% to be exactly, of the S&P 500 constituents, the actual stocks of the S&P 500, were all above their 50-day moving average. going back the last 20 years, that type of market data where we see those S&P 500 stocks 90% or above that 50-day moving average, you see gains in the next month as well as the next year. So there's a lot to be considered between now and the actual Fed meeting, but I'm a little more cautiously optimistic here as we're seeing a ton of volatility in the equities.
Yeah, you've been consistent with your messaging, Jeff, and right, of course, too. Appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.